Hey friend, great question about whole life insurance. Your question is, are you able to take out a loan in the first year without lapsing the policy? The answer is yes. That's very easy to do. As long as you're still paying the premium and if you're paying the loan interest, you're good. But I'll give you a couple bullet points that might be helpful. So firstly, when you start a policy, you can easily take a loan in the first year. The earliest you can borrow against your policy is usually 10 business days after starting the policy. The most that you can borrow against your policy is about 95% of whatever your cash value is, although I have seen a lot of companies allow you to borrow up to 100% of your cash value. But if you set it at 95% in terms of expectations, I think that's good in terms of the most that you can borrow. Now, when could a policy lapse? So if I stuff my policy in the first year and then I take a maximum loan in the first year, when year two rolls around at the beginning of year two, I'm going to be billed for my premium and I'm also going to be billed for my loan interest. In year two, if I have a maximum loan outstanding, the loan interest will exceed the dividends and interest that are being earned on my policy. Because in the early years, the growth stinks with whole life insurance. It takes a few years before I see any substantial growth or gains. So if I have a maximum loan outstanding and in year two, life happens and I say, I can't pay the premium, I also can't pay the loan interest. What I'm relying on now is for my dividends and interest to pay my premium and pay my loan interest. And typically that just doesn't work. If I have not taken a maximum loan and I still have some cash value in the policy, then I'm usually good. Because what happens if I don't pay the loan interest is the policy will take a loan against the available cash value to cover that loan interest. So again, this is only if you've taken a maximum loan against your policy and you can't pay that or you can't pay the premium. If you can pay the premium or the loan interest, not both, but one, you're usually okay. And I say that because in most cases, we'll set people up with policies where that minimum premium credits back to cash value beginning year two. So if I pay my premium and that builds cash value, that cash value can then be used to support the loan interest payment. If I'm paying the loan interest as well, then I'm good. But unless I run into a case like that where I take a maximum loan and then life happens and I can't pay anything, I'm not going to run into a lapse situation. I hope this helps.